Every major crisis looks like destruction. Markets crash, jobs vanish, homes are lost, governments scramble to react. On the surface, it feels like everything is falling apart. But here's the truth. Most headlines never tell. Crises don't destroy wealth. They move it. The people who understand this don't panic. They prepare, not emotionally, but structurally. Because crises are less about accidents and more about the rules of the game. Most of us instinctively assume that when a crisis hits, something went horribly wrong. Banks were greedy. A policy failed. The shock was unexpected. That framing makes it feel random, a system error waiting to be corrected. But history tells a different story. If crises were accidents, the outcomes would be random too. Instead, patterns repeat, decade after decade, crisis after crisis. Ordinary savers lose purchasing power or see small investments evaporate. Large institutions, governments, or insiders acquire assets at steeply discounted prices. Wealth concentrates upward. This isn't coincidence, it's structural. Think of it this way. Crises act like a high-stakes game of musical chairs, but the chairs are rigged. The same players, those closest to cash, power, and policy, always end up seated when the music stops. To truly understand what happens, we need a different mental model. Imagine the economy as plumbing. Money doesn't vanish during a crisis. It flows. When pressure hits, narrow pipes clog, weak channels collapse. Strong conduits carry most of the flow. Liquidity dries up. Borrowers scramble for cash. Assets drop in value, not because they're worthless, but because buyers vanish. Fire sale conditions appear. Desperate sellers accept the lowest bids just to raise cash. Who benefits? Those with liquidity. Those who can wait out the storm. Those already connected to the system. Central banks, sovereign wealth funds, hedge funds, they become the new owners of assets everyone else had to abandon. Even policy interventions reinforce the flow. Bailouts, bond buying programs, and emergency loans stabilize markets, but they often favor the already powerful. Meanwhile, households with savings, fixed income, or small businesses are left on the sidelines. Crisis, in other words, isn't destruction. It's reallocation. Let's look at some examples across history. The Great Depression, 1929 to 1939. Stock prices collapsed. Unemployment soared. Household wealth plummeted. Yet while small savers lost almost everything, large banks survived. The banking system consolidated over the decades. Smaller banks vanished. It wasn't random failure. It was structural transfer. Wealth and control moved upward. 1970s. Inflation. Inflation is often described as a policy mistake, but in reality, it shifted wealth. Older savers holding cash and bonds lost purchasing power. Homeowners, farmers, and equity holders saw nominal asset values rise. Inflation acted as a hidden transfer from the asset poor to the asset rich. The 2008 global financial crisis, subprime mortgages collapsed. Millions of middle-class Americans lost homes and savings. Banks were backstopped. Governments injected capital. By 2011, nearly all U.S. net wealth gains went to the richest 7% of households. The bottom 93% saw their share shrink. The 5 largest U.S. banks' share of total banking assets rose from 38% to 44% between 2007 and 2013. Stock markets rebounded, but stocks are overwhelmingly owned by the wealthy. This was not recovery for everyone. It was redistribution toward the already connected. COVID-19 pandemic, 2020 to 2021. In 4 months, global billionaires added roughly $2 trillion to their wealth, a 27.5% jump. Meanwhile, Hundreds of millions lost jobs, faced poverty, or struggled to pay rent. Ultra-low interest rates and massive stimulus buoyed asset prices, benefiting those who owned them, while ordinary workers barely recovered. Each of these events follows the same pattern. Pain is broad, gains are concentrated. The plumbing doesn't change, only the pressure points. Let's break it down step by step. Liquidity shortages and fire sales. Urgent cash needs force rapid asset sales. Prices deviate from fundamental value. Those with cash acquire assets at deep discounts. Policy interventions favor the few. Bailouts, bond buying programs, and emergency loans stabilize markets. But the distribution of benefits is skewed. Large financial players gain, while small investors or households get little. Debt redistribution via inflation or restructuring debt is reassigned, not erased. Inflation reduces real value of bonds and cash, benefiting borrowers and governments at the expense of older, asset-rich creditors. Asset price rebounds. Stocks, real estate, and other assets recover faster than wages or small business revenues. Capital income grows faster than labor income, concentrating gains at the top. Labor market weakness. Job losses and wage stagnation amplify the transfer. Falling labor share of income ensures profits accrue to capital owners. Why this matters now. Crises used to be rare, black swan events. Today, they're regular features of the global economy. Global public debt is near record highs. Geopolitical tensions persist. Financial systems are vulnerable, with concentrated capital flows. Crisis isn't a random exception. It's the operating environment. Each new shock triggers wealth reallocation. Some businesses fail, some assets disappear, but much of the financial wealth simply moves to those poised to capture it. This channel exists to expose the hidden mechanics of money, power, and crises, calmly, precisely, without hype. We don't predict crashes. We trace who benefits when they arrive. Understanding that crises move wealth, they don't destroy it, is the first step toward seeing the game clearly. Subscribe, not to react faster, but to see earlier.